Time, meaning that all owners must come on title at the same time. They must become owners at exactly the same time. Title, meaning that all of the owners must be named in the same title document, like a will or a deed. Interest, meaning that all of the owners' interests are the same, they are equal. So if two people own the property as joint tenants, it's 50-50. If three people own it, it's 1/3 each, and so forth. And possession, meaning that all owners have equal rights of possession, meaning that one owner cannot charge another owner rent for using the property, because after all, that individual is not a lessee, that individual is one of the owners. And so all have equal possessory rights. Now, Statement 41 says the most important characteristic of joint tenancy ownership is the right of survivorship. Write in right of survivorship. And Statement 42 describes what that means. If two joint tenants own a property and one of them dies, the surviving joint tenant immediately becomes the sole owner. So write in sole owner. And so this is a way of avoiding the time and expense of probate. Statement 43, in joint tenancy ownership, a single joint tenant cannot will his or her interest to another party, nor is the estate subject to probate. So write in cannot will. The individual has already agreed as to what will happen to his 50% interest or whatever the percentage is when he dies. It will immediately and automatically terminate and vest in the surviving joint tenant. And so he can't will it to somebody else. Statement 44. In a deed expressing joint tenancy, the phrase with the right of survivorship does not need to appear. Let's write in with right of survivorship. Now, sometimes on a deed you will see that the names are given, they are designated to be husband and wife as joint tenants, and then it says with right of survivorship. Well, it may say that on a deed sometimes, but it does not need to be there. It's redundant. That's what joint tenancy means, with right of survivorship. So it doesn't have to be written there, and you might see a question that would pose that idea. Statement 45 says a surviving joint tenant is not liable to creditors of the deceased who hold unforeclosed liens on the property. Let's write in unforeclosed. You might also see the word unsecured. But a surviving joint tenant is not liable to creditors of the deceased who hold unsecured or unforeclosed liens on the property. I just want you to write in the word unforeclosed, but unsecured would not be incorrect either. So let's say a brother and sister own a property together as joint tenants, and the brother has some debts. In fact, they're gambling debts associated with Las Vegas. One weekend when he is in Las Vegas, he runs into some of his creditors. And 2 days later, he is found in the trunk of his car having died of natural causes. Now, can the creditors go and attach the property that he owned with his sister? Well, the answer is no. The way the law regards it, regarding that property, he left nothing behind. As soon as he died, his 50% interest immediately and automatically terminated and vested in the surviving joint tenant, his sister. And so any unsecured or unforeclosed liens, it's too late for that creditor to enforce that debt. Statement 46, a joint tenant can sell his or her interest in the property. Let's write in the word sell. They can sell their 50% interest, 1/3 interest, whatever it happens to be. Statement 47 says if there were two joint tenants and one of them sells, the joint tenancy is dissolved and the two owners now hold title as tenants in common. Let's write in tenants in common. Remember, we started here with just two joint tenants. One of them sells, so the new owner is coming on board at a different time. Remember the four unities: time, title, interest, and possession. So that violates the four. We don't have all four just because a new owner comes on at a different time. Also not named in the same title document. We don't have a unity of title either. And so Statement 47 reminds us then that the joint tenancy is dissolved and now we have a tenancy in common. And we'll talk about that method of ownership in a moment. Statement 48, if there were three joint tenants, in other words, each holding 1/3 interest, let's write in each holding 1/3 interest, and one of them sells, the new owner comes on title as tenant in common, just like before. Let's write in tenant in common. But the two original joint tenants continue with their joint tenancy ownership. Let's say that again. If there were three joint tenants, each holding a 1/3 interest, and one of them sells, all he can sell is his 1/3 interest, the new owner comes on title as a tenant in common, but the two original joint tenants continue with their joint tenancy ownership. So if one of them dies, the 1/3 interest vests in the surviving joint tenant. But for the third owner who comes on, having just bought a 1/3 interest in the property, he comes on as a tenant in common. Statement 49 tells us of another way of holding title to real property. 49 says tenancy in common is a method of holding title by two or more persons who are owners of undivided interest in the title to real property. Write in the word undivided. Now, so far, we haven't learned anything about tenancy in common that is different from joint tenancy, but it does identify it. So let's continue with number 50. Statement 50 says, with tenancy in common ownership, owners may own an unequal ownership interest. Remember, with joint tenancy, it has to be an equal ownership interest, 50-50 or 1/3 each. But tenancy in common can be unequal. So let's say you and I bought a property together and you put up 75% of the down payment, I put up 25%. We could have an ownership interest that is just corresponding to the percentage of down payment. You own 75%, I own 25%. So it gives us more flexibility in that sense. Now, statement number 51 tells us a little bit more about this tenancy in common ownership. It says, with tenancy in common ownership, there is no right of survivorship. Write in right of survivorship. Does not exist with tenancy in common ownership. Therefore, a tenant in common owner can will his or her interest to their heirs. Let's write in can will. So if you and I owned that property together as tenants in common, 75%, 25%, obviously, if you were to pass away, you would not want your 75% ownership interest to suddenly become mine. You would want to be able to pass it along to your heirs. And with tenancy in common, we can do that. We can will our interest to our heirs. Statement number 52, the only unity with tenancy in common ownership is that of possession. Write in the word possession. Once again, one owner cannot charge another owner rent for using the property. Because that owner is not a lessee, that owner is one of the owners. Statement number 53, community property consists of all property acquired by a husband and wife during marriage other than separate property. Write in separate property. And statement 54, if a husband and wife are named in a deed and the deed does not state that they have taken title as joint tenants or with the right of survivorship, they have taken title simply as community property. Write in community property. They did not stipulate the right of survivorship. All it says is their names and they are designated to be husband and wife, and that's it. Then they did not stipulate the right of survivorship. It would have to either be joint tenancy or community property with the right of survivorship. So if none of that is there, they've taken title simply as community property. Chapter number 1, Property, Estates, and Ownership, what brokers need to know. Question number 1, legally and technically, property is defined as A, transferable estates, B, things owned, C, rights or interest in the thing owned, or D, personal property only. Best answer here is C, rights or interest in the thing owned. Question number 2, which of the following is considered real property? A bearing wall in a single-family residence. B, a maturing grape crop sold under contract. C, a refrigerator in an unattached mobile home. Or D, a leasehold interest in real property. Well, bearing wall in a single-family house is certainly real property, so A is our answer. Question number 3, a distinction between real property and personal property is that real property, A, can be owned in severalty, B is immovable, C can be left to heirs, or D is subject to tax liens. And the answer, of course, is B as in boy, real property is immovable. Question number 4, which of the following is not considered real property? A, land, B, fixtures, C, leasehold estates, or D, appurtenances. And leasehold estates, C is the correct answer. These other choices would be considered real property. Question number 5, which of the following estates represents the highest degree of ownership available? A, fee simple absolute, B, fee simple defeasible, C, life estate, or D, less than freehold estate. And A is the answer, fee simple absolute. You can just think of the word absolute as the extreme or the best or the highest, and A is correct. Question number 6, which of the following is true about a life estate in real property? A, it can be created only by an outright grant in a deed, or B, it can coexist together with another estate in the property, or C, the conveyance of a life estate must carry with it the right to immediate possession, or D, it cannot exceed 12 years in duration. Correct answer here is B as in boy. It can coexist with another estate in the property. When someone grants a life estate, typically they will hold an estate in reversion, and so B is absolutely correct. Question number 7, in the practice of real estate, the word tenancy actually means A, one or more tenants experiencing quiet enjoyment of the premises, or B, a mode or a method of holding title, or C, an encumbering device on a property, or D, a tenant with an uncommon degree of tenacity. Well, B as in boy is the answer. It is simply a method of holding title. Question number 8, which of the following is real property? A, stock in a mutual water company, B, a leasehold interest in real property, C, a deed of trust, or D, none of the above are considered real property. And the answer is A. Stock in a mutual water company is one of those appurtenant items. It runs with the land, and so A is considered real property. Question number 9, a tenant in a rented apartment and the owner-occupant of a condominium have which of the following in common? A, each party holds a fee simple interest. B, each party holds an estate in real property. Or C, each party holds a less than freehold estate. Or D, each party holds an estate they can leave to their heirs. And B as in boy is the correct answer. It is true that each party holds an estate, but they are different kinds of estates. Question number 10, a joint tenant can convey an interest held in real property in all of the following ways except A, lease, B, will, C, sale, or D, gift. And the answer is B as in boy, will. A single joint tenant cannot will his 50% interest or 1/3 interest or whatever it is to someone else. He's already agreed as to what will happen to his interest when he dies. It will immediately and automatically terminate and vest in the surviving joint tenant, so he cannot will it to somebody else. Question number 11, in tenancy in common ownership, there is legally a unity of which of the following? A, time, B, title, C, interest, or D, possession. And whereas all of these are true for joint tenancy, the unity of possession is the only one true for tenancy in common, and so D is the correct answer. Question number 12, a man owns real property in severalty. This means that he legally owns the property, A, with several other people, B, as a co-tenant with one other individual, C, as an individual, or D, while sharing equity with a lender. And the correct answer is C. He owns it as an individual. It severs anybody else's interest except himself. Question number 13, which of the following is not a test for a fixture? A, method of attachment, B, time of attachment, C, the parties' agreement, or D, the adaptability of the item. And B, time of attachment is not a test for a fixture. Doesn't matter how long the item has been attached, that is not the issue. So B is correct. Question 14, which of the following would best define a trade fixture? A, an item of personal property permanently attached in a business office. B, an item of personal property that has become real property. C, an appurtenant item. Or D, a fixture which is left behind at the expiration of a commercial lease. And the answer is A. It's an item of personal property permanently attached in a business office. Now, a good example of this is a dental chair. Every time I go to the dentist, I like the chair to be securely fastened to the floor. And they always have been, but when the dentist moves, they're going to take the chair up off the floor, they're going to restore the floor to the original condition, and they're going to take the chair with them. So in this instance, just because this fixture was permanently attached does not make it real property. So the trade fixture is an exception to this method of attachment. A is the correct answer. Question 15. Which of the following is true about an appurtenance? A, it is considered personal property. B, it is occasionally included in the sale of the real property. C, it runs with the land and has no existence apart from the property. Or D, its meaning is embodied in a trust deed. Well, an appurtenance runs with the land. Let's mark item C for the correct answer here. It runs with the land and has no existence apart from the property. Question 16. In a fee simple defeasible estate, which of the following statements is most correct? A, title is defeated only if one of the owners dies. B, the estate is subject to accelerated deterioration. C, the estate reverts to the state because of a lack of heirs. Or D, title is defeated if a condition is broken. And D, as in dog, is the correct answer. That's the meaning of a fee simple defeasible estate. Question number 17. Three people, A, B, and C, own a property together as joint tenants. A sells his interest to D. B wills his interest to E. When B dies, ownership in the property can be described as follows. A and C own the property as joint tenants 50-50. B, D and C own the property as joint tenants 50-50. C, D and C own the property as tenants in common. Or D, D, E, and C each own 1/3 interest in the property as joint tenants. Now, this kind of a question, in my experience, can drive you crazy. And so what I suggest you do is go to the double check mark column and put it over there somewhere and go back to it later. You need a clear mind to sort this out. Well, it's time for us to look at it right now, so let's review what happened here. We start with three people who own the property together as joint tenants. Each one then has a 1/3 interest. It says that A sells his interest to D. Can he do that? Yes, he can sell his 1/3 interest, so D is going to come on as a tenant in common. He didn't come on at the same time or in the same title document as the other two owners. So he comes on as a tenant in common. Then it says that B wills his interest to E, and then he dies. Can he do that? Well, he can die, but he can't will his interest. So even though he tried to will his interest to E, it really didn't happen. The law did not allow that to happen. So when B died, what happened? Well, his interest immediately and automatically terminated and vested in the one surviving joint tenant, which was C. And so C is the answer. Both D and C own the property now as tenants in common. They are the only two owners left in the ownership interest. So C is correct. Question 18. If Carol and John own a property together as joint tenants, and John owes a substantial amount of debt that has not been foreclosed upon or even secured on the property, and John dies, what is the outcome regarding John's indebtedness? A, Carol receives the property free of John's debt. B, Carol receives the property subject to John's debt. C, Carol receives the property, but John's heirs have to pay the debt. Or D, the property must be sold to pay the debt and give Carol her 50%. Well, the answer is A here. Carol receives the property free of John's debt because it had not been foreclosed upon or even secured upon the property. A is the answer. Question 19. Which of the following would be considered an estate for years? A, a long-term life estate. B, a month-to-month tenancy. C, a term from February 1 to June 30th, 2004, or D, an estate at sufferance. And C is the answer. An estate for years has a definite beginning point and a definite ending point, And C expresses that with dates beginning and ending. C is the correct answer. Question number 20. A rental agreement with a termination date is considered which of the following? A month-to-month tenancy, B, an estate at sufferance, C, an estate at will, or D, an estate for years. And D, estate for years, is the answer. The estate for years, again, has a definite beginning point, definite ending point, and so D is correct. Question number 21, which of the following demonstrates riparian rights? A, river, B, stream, C, moving watercourse, or D, all of the above? And all of the above is the answer. All of these are moving watercourses. Question number 22, which of the following demonstrates littoral rights? A, river, B, lake, C, creek, or D, all of the above? And a lake is the only body of water here with a shoreline, L for lake, L for littoral, and so B is the correct answer. Question number 23, which of the following is the opposite of condemnation? A, approval, B, abrogation, C, appropriation, or D, reversion? Now this question requires a little bit of reflection here. Condemnation is the process of exercising the ability of the government to take privately owned real property for necessary public use. In other words, under eminent domain authority. And appropriation is when an individual takes public property for private use. So it's a little bit, I'd say, sophisticated here, but if you reflect on it and know what these terms mean, C is the correct answer. Appropriation is the opposite of condemnation. Question number 24. 3 people own equal interest in a parcel of land as tenants in common. Without the consent of the others, one of the co-tenants leased the entire parcel to another party for agricultural purposes. Such a lease would be A, valid and binding for all 3 co-tenants, B, invalid because land owned by multiple owners may not be leased, or C, valid provided that the term did not exceed 51 years, or D, invalid because one co-tenant cannot obligate the other co-tenants for a lease of the whole property without their consent. And common sense and practicality prevails here. D, as in dog, is the answer. One co-tenant cannot obligate the other co-tenants for the lease of the whole property, not without their consent. D is correct. Chapter number 1, property, estates, and ownership. Some bonus practice questions. Question number 1, which of the following statements concerning riparian rights is not correct? A, a riparian owner may convey any part of his or her land that is not immediately adjacent to the river. Or B, if a riparian owner conveys part of his or her land that is not immediately adjacent to the river, riparian rights are not conveyed with that property. Or C, riparian rights may not be severed from the property by prescription or condemnation. Or D, the owner of adjacent land may not lawfully divert all available water and thereby deprive a riparian owner of water. We're looking for the statement that is not correct, and C is that statement. Riparian rights certainly may be severed from the property by prescription or condemnation, but A, B, and D are correct statements, so C is our answer here. Question number 2, if Jones conveys to Ford a portion of Jones' fee estate for a term less than his own, Jones' own interest would be classified as A, remainder, B, reversion, C, vested sufferance, or D, fee defeasible. And the answer is B, this is an estate in reversion, so B is correct. Question number 3, an uncle left his nephew 2/3 interest and left his nephew's wife 1/3 interest in real property jointly and without the right of survivorship. They will assume title to an estate that is classified as A, community property, B, joint tenancy, C, tenancy in common, or D, partnership. The only possibility here is tenancy in common because they have unequal ownership interests and they do not have the right of survivorship. C is the answer. Chapter 2, we're going to talk about encumbrances and the transfer of ownership in real property. And there are some very significant concepts that we need to get a grasp on in this chapter. First of all, dealing with encumbrances, statement number 1 says that an encumbrance is any right or interest in the land possessed by a non-owner of the property in question, which affects the value or use, right, in value or use of the owner's estate, but does not prevent the owner from transferring his or her interest. The owner owns the property, but somebody else has a claim on the property due to this type of encumbrance. Now, statement number 2 says an encumbrance is a burden on the property. Write in the word burden. Obviously, it would be better to have a property that didn't have any type of encumbrances on the property, but remember, we can never own a property with absolute freedom and power. We're always subject to governmental burdens and possible claims of others. Statement number 3 says encumbrances fall into 2 basic categories. Those that affect title, these would be called money encumbrances, right in the word title, and those that affect physical condition and use of the property, right in the physical condition and use of the property. Those would be the non-money encumbrances. So 2 basic categories, money encumbrances and non-money encumbrances. First of all, we're going to talk about the money encumbrances. An encumbrance that affects title is called a lien, right in the word lien. A lien is a money encumbrance. Statement number 5 says that a lien is a charge imposed on the property, where the property is made security for the performance of an act, usually the payment of a debt, right in payment of a debt. A lien involves money. Now, there's a lot of money associated with real estate. This is just a drop in the bucket compared to what most real estate will command. And because of the fact that real estate has such value, liens are placed upon real estate to assure the payment of money. So just associate there the word liens. The S at the end of liens is a $sign. A lien involves money. Statement 6 says, when a lender records a deed of trust securing a purchase money loan, the lender creates a lien against the property. So write in the word, once again, lien. Recording a deed of trust creates a lien. Statement 7 says, a deed of trust or trust deed is used when a buyer borrows money from a lender to purchase a property, and the title to the property is held in trust, right? Held in trust by a neutral third party, right, in neutral third party, until the loan is paid off. The title to the property is held in trust by a neutral third party until the loan is paid off. Statement 8 says the deed of trust is a security device known as a security instrument, right, in security instrument. So the note is the evidence of the debt. It tells us how much the borrower has borrowed, what the interest rate is, what the payment is. And the deed of trust is the device that secures that note on the property. It makes the property collateral for the collection of that note. Statement 9 says when a buyer borrows money from a lender in order to purchase a house, the lender records a deed of trust to secure the loan, right in the word secure. So if the borrower did not pay the money that is owed, the lender can actually foreclose on the property because the debt is attached to the real property. Statement number 10, the deed of trust is recorded in public records and shows there is a lien on the property. Right in the word, once again, lien. Now, statement 11 gets into the parties involved here. A deed of trust involves 3 parties, right in 3 parties. The borrower, who is called a trustor, and of course is the buyer of the property, right in buyer. And the lender, called a beneficiary. That's the bank, that's the party who loans the money. And the neutral third party, known as the trustee. The trustee holds temporary title not full title, but temporary title, the essence of legal title, until the lien is paid. Statement number 12, to remove a trust deed lien on a property, for example, when the debt is paid, the lender causes a reconveyance deed to be recorded. Let's write in reconveyance deed. Now let's take a look at this. When the trustor signs a deed of trust, what he is doing is he is conveying the essence of legal title to a third party known as the trustee. The trustee holds that temporary essence of legal title until the debt is paid in full. But once the debt is paid, and it might be through the sale of the property or through lengthy, painstaking making of payments over the term of the loan, or it might be through a refi, but when that debt is paid, the trustee will sign what's called a reconveyance deed. Now, this is a document that has been named exactly the right thing. If you think about it, when the trustor signed a deed of trust, he conveyed naked legal title, or the essence of legal title, to the third party known as the trustee. Now the debt has been paid, so the trustee is going to sign a reconveyance deed. We're going to reconvey or convey back again to the trustor the essence of legal title. Statement 13 says the party who signs the reconveyance deed is the trustee. Write in trustee, the neutral third party. He's the only one who can sign the reconveyance deed because he's the one holding the essence of legal title. Now, statement 14 says when a seller carries back a second trust deed, a lien is created against the property. Let's write in the word once again, lien. Money encumbrances are created by liens against the property. Now, this idea of a seller carrying back a second trust deed, a lot of people have just gotten involved and started paying attention to real estate over the last 6 or 7 years, or maybe even a shorter time ago than that. And I was thinking that, a lot of people may not be aware of what it means when we say a seller carries back a second trust deed. So I'd like to break that down for you in case it's something that you're not familiar with. We haven't really been seeing sellers carry back a second trust deed very much in the last 6 or 7 years in the conventional practice of real estate. So let me tell you how this works. Let's suppose we're in a different kind of marketplace. We're in the kind of marketplace where it's a tight money market. Interest rates are higher, it's harder to borrow, qualifications are tougher, and money is not as readily available as it is right now. And just to keep the numbers simple, let's suppose we have a selling price of $100,000. Maybe some of you can remember back in the days when selling price could be $100,000. So the selling price, $100,000, the buyer has a down payment of $10,000. Now normally he could borrow $90,000 to complete the purchase of this home. But this is a tight money market. He can't borrow $90,000 right now. He can borrow, however, $80,000. That will be an institutional first loan. It'll be his purchase money loan. So let's say from Washington Mutual or some other institutional lender, he can borrow $80,000. He's still got his $10,000 down payment, but that means that he's $10,000 short on the $100,000 purchase price. If the seller wants to sell to this buyer in this marketplace, and when it comes to a marketplace, you have to be attuned to the realities of the marketplace. You can't make it what you'd like it to be. It is what it is. So this buyer is typical of all buyers in this kind of a marketplace. And so if the seller wants to sell his property at this time to this buyer, he's going to have to help with the sale. And so he's going to have to carry back a second trust deed in the amount of $10,000. So what that means is we're going to instruct escrow to draw up a new note in the amount of $10,000 payable to the seller. And at close of escrow, escrow will cause to be recorded a trust deed made out to Washington Mutual and a note made out to Washington Mutual. The note is not recorded, but the trust deed is. And that will be recorded first. It's the purchase money loan. Right behind it, in second position, will be recorded the trust deed that secures the second note for $10,000. That note will be made out to the seller. And once escrow closes and the buyer owns this house and he comes to make his first payment, he will write one check to the institutional lender for payment on the $80,000 loan. And he'll write another check, a much smaller check, to the seller for payment on his second. So that's what it means for a seller to carry back a second. An actual note is created in escrow, secured by a deed of trust, and it'll be in second position behind the purchase money loan. So 14 says when a seller carries back a second trust deed, a lien is created against the property. Now there's other kinds of liens. Statement 15 refers to the IRS tax lien. And when the IRS records a tax lien against a taxpayer, that lien is created on any real property that they own. And that lien is called a general lien. Let's write general lien in the blank. When a lien affects all property that an owner owns, it's called a general lien. But sometimes we have what's called a specific lien. Statement 16, when the tax assessor assesses property taxes against a property, a lien is also created, and it's called a specific lien. Let's write in specific lien. It just means that it attaches to a particular property. So we have general liens and we have specific liens. Now, starting with statement 17, we're going to be talking about a different kind of lien, and this is called a mechanic's lien. Statement 17 says, a mechanic's lien is placed on a property by someone who provides labor or material for the property and has not been paid. Let's write in labor or material. It has been recognized in the law for many, many years that when someone provides labor or material on a property, that tends to enhance the value of the property. So there's tremendous benefit to the owner of the property. And so the law establishes the fact that it's only right then for the owner of the property to pay promptly the person who has provided these kinds of services and has enhanced the value of the property. But if they don't, there are procedures for a mechanic's lien to be placed on the property. Statement 18 says a mechanic's lien must be verified and recorded to be valid. Let's write in verified and recorded. Verified means signed under penalty of perjury. And so they make mechanic's lien a very serious thing in the law. From the standpoint of a realtor and a buyer, sometimes a mechanic's lien can become somewhat of an obstacle to closing. Many years ago, when my children were still pretty small, and I have a daughter who's 26 years old and a son who's 22, but when they were little, I had sold one of these HUD repos out in 29 Palms, California, and it was set to close that year on a Friday, December 22nd. And I'll never forget this one because that morning, Friday, December 22nd, I get a call from escrow. Now, as you can imagine, having a couple of small children and an escrow closing on December 22nd, I kind of had some plans for that money. Escrow says to me, "Did you hear? It's not going to close." Not going to close. I reached through the phone line and I grabbed somebody by the throat and I said, "Why isn't it going to close?" And they said, "Well, we just discovered there's a mechanic's lien on the property." Now, I never could figure out why in a 45-day escrow it takes until the morning of the 45th day to notice there's something wrong. Turns out some lady apparently had installed a screen door on this house a long time ago, and she claims she never got paid, so she recorded a mechanic's lien for $100 on this house. Now, in those days, mechanic's liens could just stick around indefinitely, and this one apparently did, and we finally, of course, set the money aside in escrow and we closed anyway. But from a realtor standpoint and from a buyer standpoint, mechanic's liens can sometimes be somewhat of an obstacle. Now, Statement 19 says that a mechanic's lien may take priority earlier than the date it is recorded. Let's write in the word earlier. Let's suppose, for example, that a work project on a house begins in October, and a second trust deed is recorded in November. And in December, a mechanic's lien is placed on the property. Well, the mechanic's lien is about the work project that began in October. And so the mechanic's lien will actually jump in priority back to October and ahead of the second trust deed that was recorded before the work began. In other words, the mechanic's lien will get paid first, and so it can actually jeopardize the security of that trust deed. Now, there are some procedures to be followed when this is necessary. Statement number 20, a preliminary 20-day notice must be filed by a claimant prior to recording a mechanic's lien. That's right, prior to recording. So the person owing the money would have an opportunity to know that this is what's happening and to make it right with the person who is making the claim. Statement number 21, there are some notices pertaining to mechanic's liens. I'd like you to write them in the blanks here so that if you saw these in a question, you'd recognize that this is what they're about and you could answer accordingly. In statement number 21, let's write notice of non-responsibility in the first blank, notice of non-responsibility. In the second one, notice of cessation, notice of cessation. And the third one, notice of completion. Notice of non-responsibility, notice of cessation, notice of completion. Those would be three notices you would want to be able to recognize as being part of mechanic's liens. Now, statement number 22 says that a mechanic's lien may be filed by the original contractor within 60 days, fill in 60 days of filing for record of the notice of completion. 60 days for the original contractor. Statement 23 says a mechanic's lien may be filed by any claimant other than the original